with some students, and I just wanted to share a couple of things that I was talking about with them, if that's all right, Chloe, if I may.
No worries.
We're gonna move across some asset classes fairly quickly. So a couple of things I want to just discuss. The first thing is what happened on Friday. For those of you that aren't aware, there was a bank in the US, a regional bank in the US, that got into financial difficulties and I think has failed on Friday. That created some pretty insane volatility in both the front end of the Treasury bond market, the Treasury note market and bill market, and also in the back end as well too of the curve. So there was a significant fall in interest rates. So that means that bond prices rallied. And in fact, the moves in the very front end of the curve, that means anything up to a couple of years, was actually so significant. In fact, I think it's only actually happened, moves at that scale about 3 times in the last 50 years, actually the length of time that contract has been running. I might just want to quickly share my screen just to illustrate something, because I think from a trading lesson point of view, it's always nice just to go back and say, oh, okay, is there anything that we can learn from a move like that to help us with our trading going forward? So just in terms of an educational piece, let's just have a quick look, and I'll just share my screen very quickly here. Hopefully I can share my screen. And just hold on 2 seconds. Thanks, Sam. Hopefully you guys can see this. Chloe, maybe you could just yell out if you can, once this becomes clear to everybody.
Yeah, I've got
okay, brilliant. Okay, guys, so this is the what we call the euro dollar futures. So this is the very, very short end of the US interest rate curve. So interest rates go from like 0, which is where the Fed funds that you hear so much about on the news, is all the way out to 30 years, right? So there's a price, if you like, an interest rate for each of those periods of time. So at the moment, the curve has been what we call inverted. So interest rates in the very short end, so think Fed funds and what you pay for mortgages and stuff, is very high. And then as you go further and further out, those interest rates fall away and the curve's inverted, what we call inverted. So a very good predictor, allegedly predictor of recession. So what happened on Friday was everybody panicked. Now, what do I mean by that? Is people took their money out of the bank, because this is what happens when people lose confidence in the bank. I get my cash out as quick as I can, and I've got to go put it somewhere. So where do I put it? Well, I put it into gold, right? That would be a good thing for those of you following the gold market. That asset class moved up very quickly on Friday. And they also put it into the US Treasury market. Why? Because the safest place in the world is in terms of interest rates, in terms of where you put your money, is the US government. So why not go and buy a US government bond, right? Then you know you're going to get your money back. And that's what this is all about return. This isn't about anything to do with interest rates now. This is about getting your money back. So of course you go in there. So we had a couple of moves. This is a daily chart of those Eurodollar futures. And look what happened on Thursday and Friday. I'm just going to highlight these 2 days. On the right-hand side is the interest rate, which is inverted from 100. So where it says 95 down here, that means 5%. Where it says 96, that means 4%. So what happened is interest rates fell, the market rallied in Eurodollar futures, interest rates fell, okay, and over the course of 2 days. And you say, hang on a second, didn't the bank failure happen on Friday? This day here, do you remember we had the big unemployment number, and it was all very exciting with a reasonably big unemployment number, a little bit above expectations. The market was thinking, it was worried about a big unemployment number because it would confirm that interest rates were going to stay higher for longer. But what happened on Thursday was we already had the inklings of something really odd happening. So in front of an unemployment number, when everybody's really nervous about taking positions, the market made a really strong statement and took out 8 days of trading. So that's why price action, watching price action is very important. If you were a trader and you had a short position here in these futures markets, right, you'd look at this, you go, oh, something's happened here. I've either been taken out because my stop loss would have been taken out if I was short, or else I'd be on full alert for something going wrong. So there was already on Thursday the inkling that there's something was happening regardless of what was going on in the macroeconomic environment. And then on Friday, bang, we had this big move when the bank news, the failure news came out, right? So already the market had an idea that something was going wrong. So when you look at gold, did we have that exact same thing happening in the gold market? And the answer is, oh, look, yes, we did. So gold, as we know, has been a little bit all over the place recently, but quite frankly, as interest rates, as the Fed is readjusting its interest rate expectations for everybody, i.e. longer for higher for longer, right? Gold has suffered a little bit over the last month or so, and then here we go. Look at this, the last couple of days, bang, and then bang with gold. Up it goes, right? A lot happened on Friday, but did it move before? Did the market have an idea of what was happening? Yes, it did. This is not a conspiracy. This is just saying that some people in the marketplace were concerned enough to change their positions. So sometimes news takes time to get out. We now know with some hindsight that there were already problems. S&P had highlighted, their ratings agency had highlighted the problems of that bank over 10 days ago. So there were already something going on, but look, we're traders, we're global macro traders. We're not following bank stocks or specific banks. We don't know what's happening. So we don't have that insight, okay? But other people in the market do. So what you have to do is to respond to what you're seeing. So then the question is, because we're thinking trading, is what's going to happen on Monday? Now, this is where the world gets interesting. You could say, is this a storm in a teacup, albeit a large teacup? Or is it something new and something systemic happening? Well, the answer will unfold on Monday. So it's very important that Monday opening in the Far East to understand what the market is thinking about what's going to happen next, and then whether you need to take action a different way to reverse what's been going on, or to maybe go with the trend a little bit as well too. So I can't talk about what could happen, but let's talk about where it's been and what signals there have been, right? So I just thought it was quite useful to just bring this up and just highlight to you what's been taking place this week, in spite of the good economic unemployment numbers, the good economic employment numbers that we're seeing. The US economy isn't in such bad shape, hence the higher for longer discussion that's been going on around interest rates. And then this happens. The question is, does it then reset everybody's expectations again? And that's the key thing. This is why trading is so much fun, and we live in this world of constantly moving goalposts about what's actually trying to go on. What we need to do as traders is focus on the price action. That will always give us some clue about what's happening next. And the clues were there in the market if you looked for it. And obviously, for those of you that trade the stock market, we saw a general movement down on Thursday, which was then followed by supporting again on Friday, right? So you could see that the market already again had an inkling that something wasn't quite right. And just to give you an example, without getting too specific, if we just go and look at Bank America, right, as one bank stock, was there something happening? So Bank America is quite a big stock. Was there a problem in the market a few days beforehand? Yeah. Did it finally take until Friday to come out? Yes, it did. So in other words, people thought there was an issue because this is one of the biggest banks in America. The price is going down. Look at this move, right? This is a 10% move. They thought something was happening, but they thought something was happening over 2 weeks ago, right? There was a little bit of nervousness. So again, if you follow sectors, if you're delving into this, you could have got some clues. Did you know there was going to be a bank failure? Probably not, right? So this is why sometimes what we have to do is look at that price action, reinforces the price action, and we just try and do what we can to interpret what we can see, right? And that's the key thing. So again, nothing happened in oil. Look at what happened in gold, right? You see this big move up over a couple of days. And that's pretty substantial move up, okay, against the last few days where, again, people are probably short, wrong side of the boat, and now they've had to cover quickly. Chloe, that's it from me.
I can never find the unmute button when the video is on.
That's all. I was going to keep talking for a minute.
I've got it. Thanks, Julian. That's really interesting stuff, and it's interesting, isn't it, that there are fundamental traders and there are technical traders, and kind of marrying the two up can be not the easiest thing to do, but it is still possible to do one or the other. But we just have to take into account what's going on and try and work out how we make the most of those moves with the knowledge that we do actually have. And usually it does take just kind of seeing what's happening in the market to get a little inkling, as you say, of what the next move might be.
That's absolutely right. And look, I think with all of these things, right, everybody's in a different part of their development as a trader. And, I have the advantage of a few years experience, so I can look back on it and I can go, okay, well, I've seen this rodeo a couple of times before. But not everybody's been through that, right? So what you need to do is to focus on the price action, say something new is going on. If I have the opposite position on and I'm wrong, then I'll tighten my stops up and get taken out, which is absolutely fine. That's what stop losses are there to do. right? So it protects your risk one way or another. And again, if you've been making money, then it takes you out and means that you're not suffering the complete reversal. It's actually a really good lesson in risk management, is actually what happened on Thursday and Friday, as to how to manage your positions and think about things the way they were. For those of you that are trading mostly foreign exchange, you probably didn't see a lot of change, right? Apart from the Swiss franc, there wasn't a lot going on in the foreign exchange market, because often when this type of financial calamity starts to unfold, what happens is the foreign exchange market goes up. Okay, we'll just wait and see what happens now, and then we'll react next week. So once the money starts to flow again, right? So this was a specific asset market movement. But again, look, really important, really educational, amazing. It's lovely, I wouldn't say lovely, but it's interesting to see this type of price action in the markets that we're seeing at the moment.
It definitely is. And yeah, as you say, Julian, it's something that we can look forward to next week, perhaps, is how the foreign